And yeah, and also it would be polite if you remain not muted, but that we can see you right on the screen. So just remain in front of your computer due to the recording issue, right? So overall, we have 6 talks, meaning 15 minutes each talk plus 5 minutes discussion, and I will be the timekeeper here. And I hand over to Monika for the first talk, European Central Bank Strategy Review and the Management of Inflation Expectations. Monika, it's your turn.
Yeah, thank you very much, Alexander. I will share my screen so that you can see my presentation. So, can you see it? Yeah. Okay, great. Yeah, my name is Monika Wohlmann. I'm professor of economics at the FOM University in Düsseldorf. And I will talk about the European Central Bank Strategy Review. And I wondered whether these changes will really help to improve the effectiveness of monetary policy. And this is where my investigation is about. I will start first to give you some theoretical background. Why is the management of inflation expectations important for monetary policy? Then I will talk about the main changes that have been introduced this year in the monetary policy strategy of the ECB. Then I will come to my empirical study and conclude with an assessment of the new ECB strategy. First, about the effectiveness on monetary policy and the management of inflation expectation. Why are inflation expectations important for monetary policy? And here I have a model, a communication model, which shows us at which point the management of expectations is important. I will start at the top. Here, the ECB objectives of the central bank are to maintain price stability. This price stability is then defined in the monetary policy strategy. And then the central bank takes its decisions based on the strategy and based, of course, on the economic situation. And these decisions are then reflected in 2 parts. On the one hand side, they take some actions. They increase or lower interest rates. They increase their asset purchases, etc. These actions have a direct implication on financial markets, because financial markets will then react to the change in interest rates or the change in asset purchases. But the second part of these monetary policy decisions is the outlook, the outlook on the future monetary policy, what we call the forward guidance. And both parts of the monetary policy decisions are then communicated to the public and to the financial markets. And here, this communication is a guide to the expectations, to the inflation expectations. So here is the management of expectations. But as we know, communication is sometimes difficult, and what the sender wants to send is not always what the receiver will receive. So here is the difficult in between. But these expectations are important because they will also influence the actions which then either the consumers or the financial market participants will take. And their actions then have an impact on the economic situation. So coming to the strategy review of the European Central Bank, first, I want to shed a light on the background, because the ECB said that the environment has changed significantly since the last review in 2003. Especially, they stated that the real equilibrium interest rate is much lower than before. And they said this is due to basically 2 factors. One, we had some disinflationary shocks, the financial crisis and the corona pandemic crisis. And we have some structural factors like globalization, like digitalization, and the demographic factors, which also have a disinflationary impact. Therefore, the ECB thinks that we will have a persistent low inflation. And they also said inflation expectations in the past have fallen below their target. And the third point, they want to have an inflation buffer because they say we have more disinflationary pressure than inflationary pressure. So they want to have a buffer against deflation. And on this basis, they changed their strategy. First, the headline harmonized index of consumer prices remains the measure for price stability, but the ECB wants to introduce owner-occupied housing into it. So this gave rise to my first question. Is there actually a discrepancy between actual and perceived inflation? So is maybe the HICP not measuring inflation correctly, so that what consumers perceive is different from what is measured? Then coming back to the policy review, the ECB introduced a quantitative target of 2%. Before they said our target is below but close to 2%. Now they really defined it at 2%. And they said it's a symmetric target, so they will not only tolerate an overshooting, but also they won't tolerate an undershooting. They stick to it that it's a medium-term target. So what they want to achieve is they want to anchor the longer-term inflation expectations at 2%. What we can say about this change is it's clear, it's simple, such an inflation target, and that should better anchor inflation expectations. And the ECB also hopes to lift inflation expectations to 2%. This gave rise to my second question. How accurate were inflation expectations in the past? So is there really a need to adjust them to better manage them? To study this, I used the data from the consumer survey of the European Commission. So please be aware, we are talking only about consumers here. There is some evidence that inflation expectations differ a lot between different groups. So we are only talking about consumers here. And in the consumer survey, there were asked two questions. How do you think that consumer prices have developed over the last 12 months? So this is the inflation perception. And another question is about, by comparison with the past 12 months, how do we expect that consumer prices will develop in the next 12 months? So these are the inflation expectations. I compared them, out of these answers, a balanced statistic is computed, so they're all aggregated in one value. Be aware, we are not talking about the level of inflation, just about the change of inflation here in these questions. I compared them to the harmonized index of consumer prices from Eurostat, and the sample goes from 1997 to 2021. My analysis was on a country level. I used the 5 biggest countries in the Eurozone: Germany, France, Italy, Spain, and the Netherlands. Because on the one hand, I thought that people in their own country should be better able to assess their inflation in the country, and I wanted to look for country-specific differences. For the question, is inflation correctly perceived? I used a correlation analysis to compare the perception with the actual inflation. And for the inflation expectations, I used a Granger causality test, because if expectations are correct, they should be a good predictor for actual inflation. I had to prepare the time series. I tested for stationarity, and for normal distributions, I had to do some amendments because they were not all stationary, and some of the series are not normally distributed. Therefore, here I refer mainly to the Spearman correlation coefficient, as the Pearson correlation coefficient is only used for normally distributed time series, and this is not the fact here. I put the one which were not significant here in brackets. The all other correlations are significant, but we see they are fairly low. And I was a little bit surprised by this low correlation, I must admit, because there are some studies from the ECB for different time periods and they show higher correlations. Therefore, I also tested for lags, but the correlations remained that low. Only for the Netherlands, I found a higher correlation for lag 1. So all in all, we can say we have significant but low correlation between inflation perception and actual inflation. This is in line with some studies which actually say that consumers and companies are rather poorly informed about inflation trends. What could be the explanation for that? On the one hand side, maybe consumers perceive the everyday prices more strongly, so their perception is biased. Then there is also some evidence that maybe the study have some problems with the data collection, so that data is not accurate. And the last explanation would be that the harmonized index of consumer prices is not measuring inflation correctly. And this is where I looked at, because if you remember, the ECB wants to have some amendments to the HICP. They want to have owner-occupied housing included. And I took a look whether this is an important issue in the countries under investigation. And we can see that especially in Spain and Italy and the Netherlands, the share of owner-occupied housing is above the average. And the correlation analysis showed there was no correlation in Italy and a low correlation in Spain. So that gives us some hint that maybe this amendment of the HICP could bring perceived and actual inflation better together. Then regarding the inflation expectations, the Granger causality test showed, except for the Netherlands, no relationship between actual inflation and inflation expectations. Then I tested for lags because maybe consumers are not able to exactly predict the inflation in 12 months. And for Germany and France, still the causality was not there. But for Italy, Spain, and the Netherlands, we can roughly find that inflation expectations in 12-month time match more or less inflation. So we can say for Italy, Spain, and the Netherlands, inflation expectations can be classified as approximately correct. But for the two biggest countries, Germany and France, expectations are pretty inaccurate. Then I made a reverse Granger causality test to see whether actual inflation does impact expectations. And here I found a significant relationship for Spain, Germany, and France if we allow for a 10% significance level. So what does that tell us in the conclusion about the ECB strategy review? First, we can say, yes, there is a need for action because inflation expectations have proven to be inaccurate, especially in the two biggest countries, Germany and France. Regarding inflation perception, the amendment of the harmonized index of consumer prices for owner-occupied housing could move perceived inflation closer to actual inflation. Regarding the management of inflation expectations, here the ECB introduced the quantitative and symmetric target. This could be a good point because it's simple, it's clear, it could help to anchor inflation expectations. But on the other side, the ECB says its target is only medium term. So this again opens up room for interpretation. So there remains the dilemma between clarity on the one hand side and flexibility in its action on the other side. And this dilemma can probably only solved by a proper communication. So it is welcome that the ECB gives an important role also to its communication policy. Another result from my analysis was that current inflation rates impact expectations. So the ECB is advised not to tolerate excessively large or lasting deviations from the inflation target because they might have a significant impact on the expectations for the future. And last to mention, the ECB is aware of this problem, how to manage inflation expectations. They introduced a new survey in July this year, the Consumer Expectation Survey. And at least with this survey, they want to gather accurate data about the expectations, which maybe at least will help them to measure the expectations properly. I thank you very much for your attention. I will be happy to answer your questions.
Yeah, thanks a lot, Monika. Perfect timing, 15 minutes. Great. So we have time for a couple of questions. So this is really interesting stuff because we talk about higher inflation rates in Germany, meanwhile, almost each day, and we are fully aware of the Fisher effect. So getting the inflation expectations higher means long-term interest rates. And then this is bad news for investment. So the floor is open for a discussion. Who would like to start and break the ice?
Can I?
Yeah, of course. Klaus, please.
Question, yes. Well, coming from a historically from an area where we have had very high inflation rates and also high inflation expectations, and having seen the last decades also where we even talked about will we ever come back to inflation? Yes. So the situation, there are two questions arising. First, what is inflation? Do we really, if in the sense of Milton Friedman, we have to have an explosion of money? There's lots of money out there, so there could be, but well, you know, we may not return fast, or maybe not at all to this. And second, I mean, the current movement of prices has to do with for instance, supply shocks and rise of energy prices and these kind of things. So we know also that this only gets to inflation if, I mean, let's say trade unions behave wrong and so on, wage wages are rising too much. So the issue is what is inflation today and why? I mean, isn't there a need to adapt first? I mean, when you have practically no inflation over the last years, even sometimes prices went down, we have to adapt as consumers to the situation. We have to realize, oh yeah, there was inflation yesterday. So isn't it? We have not to go through a phase of transition. That would be my second question, so to speak. Before, I mean, a normal analysis is reasonable.
Yeah, thank you for your question. Actually, that's a good question. What is inflation? We usually say that inflation is what consumers, the prices for consumers. We always measure consumer prices, but we see that, for example, this point that the ECB wants to include the owner-occupied housing gives a hint to the housing prices. We had a very big inflation in housing prices in the last years. And there's a question whether this should also be recorded, at least partly maybe recorded in an inflation index or not. So there are big rises in other parts of the economy which are not impacted or not included in the consumer price index. So I think this is actually a discussion or a point at the moment where they're thinking this amendment of the HICP, which a little bit hints at this point that maybe there are some other things which should be taken into account as well. Then, of course, what do we want in the end? We are not only talking about price rises, we're actually talking about the stability of our money, because the point in the end is when prices rise, we lose the faith in our money, and with inflation, then our whole financial system collapses. So do we correctly measure the stability of our money? And this is the second point where also we see on stock market index, on housing prices, we see big rises, we maybe see bubbles building here, and all these are not in our measurement of price stability. The solution for the ECB is then to do two things: price stability on the one side and financial stability on the other side. And we also see that in the last years, the ECB has really given more importance to the part of financial stability than before. So I think they try to capture these price rises in their part of looking at financial stability.
Okay, so thank you. I'm the timekeeper, and the time schedule is pretty tight, so we have overall 20 minutes for each session. Sorry, that is the external threat here that we cannot continue discussion, although it would be very interesting. So Monika, thanks a lot for your talk. And the second speaker is Sascha, Retail Location Choice Model, the comparison of Gravitation and Logit Model. So this will be tough econometric stuff. Sascha, it's your turn.
Yeah, thank you. I'm just connecting here and then we'll start. Okay, can you see the screen?
Yeah.
Does it work?
Fine.
Oh, okay, great. So just start my stopwatch here. Yeah, thank you very much. Today I'm talking about location models for retail stores. A little bit of background. So this presentation comes from research from I do at Hasso-Plattner-Institute, and we're doing that together with a startup company called Tagomo. And the overall idea of the project is that we try to automate location decisions for companies. So before, it is like consultant is coming and telling them, okay, which is the best location for your stores, and we say, well, we have all the data, and it should be possible to automate this. So this is the overall thing. It's a two and a half year project, so quite a big thing. And what I did in the beginning of the project actually was comparing the theoretical models behind it. So this is where this talk comes from. And this is also the starting point here. So we have the problem that we have two models which are well known, which is the Gravitation Model and the Logit Model, but nobody really knows which one is better. Even if you look at the literature, it's completely open, I would say. So one paper says this one, the other says this one. The next problem with this is we have very little real revenue data, so which is what we usually would need. So we would need revenue data, and then we could say, okay, a location of this yields more revenue than another location. This is what we needed to do, but unfortunately, the companies usually keep them private, so it's quite difficult to use the data. So we thought, okay, but we need some solution. So what can we do? Maybe we can compare the theoretical form, the functional form of both models, because it at least tells us, can we, with the same data, would we come to the same outcome? So that was the idea. Then see, okay, how's the usability? So meaning, is it possible to predict the parameters of the model? And the second one is we did a big simulation with real location data, and so okay, what's really the difference in the real world data of both models? So that's what we are doing here. Yeah, a little bit a look into the literature. These models are pretty old. So this gravitation model, this is this Hoof model from 1964, and despite being quite old, it is still used a lot. Logit, I think a lot of people might know Logit already, because it's a common model for discrete choice. It was invented. Now this is a mistake here. This should be 59 and not 95. No, sorry, this is 59. Yeah, and this one is often used in economic situation because it's consistent with our usually things of utility maximization. There are various papers using both models, so either one or the other one, usually on data on grocery stores in the US, because obviously they are a little bit more open with their data. We tried to get data from German chain stores. This is nearly impossible. There are two recent papers, or more recent papers, comparing this. This is Sartorius who compares data from Rewe, different Rewe stores. So he has Rewe data. It's quite anonymized, but still usable. Lademann, they took a different approach, which is a little bit funny. They just went to the supermarkets and waited in front of the supermarkets and asked the customers, because they didn't, the supermarkets didn't give them data, so they just asked them, okay, how much did you spend? Why did you go to this store? Okay, but it is really a problem of data we are having here. Both models have the same underlying logic, I would say. So what we do also later on in the simulation is we calculate, or we want to calculate the number of consumers who go to one store. This is the CJ here. And we say this is the sum of consumers from each grid cell. So we're having gridded population data, and we just add up from every cell who goes to that supermarket. So this is this one. And well, who goes? Well, it's the number of people living in that grid cell times the probability that these consumers choose this supermarket and don't go somewhere else. So this P is the interesting variable here. After having the number of consumers, it's easy to calculate the revenues. You just need the expenditure share and the income of those households. So this is this one, which not so interested now for us. But the interesting thing is this P, this probability that a consumer from cell E goes to store J. And there are mainly two factors influencing this probability. One is the travel time. So we say, okay, the longer someone travels to a supermarket or to any other shop, the less likely it is he goes there. And the second one is the attractiveness. So if you have a very interesting, nice shop where you really did find everything, you might be willing to travel a little bit longer. That's the idea. Those two factors influence the decision. One negatively, the travel time, and one positively, which is the attractiveness of that store. Now, how to measure this P, this probability? And this is actually what both of the models do. So the gravitation model and the Logit model, I briefly introduce both of them. The gravitation model is something which is very old, and it's based on Newton's law of gravitation, where he says, okay, to stars or whatever have a certain weight and a distance, and how much they move to each other. This is determined by this law of gravitation. And what Rayleigh did already in 1931 is he just used that one, and yeah, he used it for economic things, but also for movement of population between towns, for example, this is used. With real data, the prediction is surprisingly good, although the background with physics, okay, a lot of people don't like that, and I would follow that. So because there's no real, no good theoretical explanation of what is going on here. The problem is also that it's completely deterministic. So there's nothing like uncertainty in this model. When we think about shopping, there's certainly a bit of uncertainty. I mean, I may live next to Aldi, but I don't like Aldi, so I always go to Rewe, for example. So these things happen. So this would work. And Huff, I don't know how to spell that person. In 1964, he turned this into a stochastic model, and this is what we have here. So the probability of a customer from cell E going to supermarket J is this this term here, where we have positive influence of attractiveness and the negative influence of travel time, and here in the denominator we have the rest, the same for the rest of the shops, and the one who yields the biggest utility or the highest utility, this is the one the consumer chooses. So that is this model. The Logit model, I think some of you will know the Logit model. Logit is a basic model for discrete choice. It's not only used for location choice, but for anything else, like choosing which brand of car to buy or something like this. There is a binary form which is easy to explain, and a multinomial form which is a little bit less easier to explain. The binary form is quite simple. So we have an event which can occur, then it's 0, it's 1, or it cannot occur, then it's 0. And what we want to predict is the probability of that event to occur. So let's say the probability that my consumer goes to a shop. And if we have a distance here, then the probability gets lower the bigger the distance is, because it just doesn't want to travel so long. And this is modeled by an S-shaped curve. So this one, or opposite S-shaped curves, which is the logistic distribution. Logistic distribution has this S shape. There are also models with a linear relationship, but they are not really useful here. So this is from this logistic distribution is where this probability comes from. This one is quite easy. So it's okay, someone who lives 2 kilometers away, he has a probability of 85%, 82% maybe, going to that shop. Someone who lives 4 kilometers away has only a probability of 0.1%, but it's still there. He might just like that shop, although it's far. The multi-nominal thing, to explain that in depth, I think that would be too much for this talk. It's something McFadden invented here in 1974. So we have that equation here, which shows the probability of going out of choosing one alternative out of many other alternatives. Even here, it's from the basic idea, it's the same. We have the utility of going to that shop here, and we have the utility of all the alternatives here. So the consumer chooses the one with the highest utility. The only difference is, if you compare this one to this one here, is the functional form here and here. So those are the differences. Yeah, so we wanted to compare this. We looked at the functional form and found out setting the parameters in the right way. We did this with a simulation. We find a very similar form. So the blue one here is a gravitation model form, and the orange one is a Logit model. The biggest difference here is that is in the end, it's difficult to see here, but in the end we have a difference because the logistic distribution has fat tails. In the end of the distribution, it's not 0. And this is important for people living close to a supermarket. So this changes the probability here. We used data, location store data from the Google Places API for the simulation now. We have the census data population in 100-meter grid, which is quite a lot, but very interesting. And we have the road map network from OpenStreetMap. I choose a sample from medium-sized city, Lübeck. It has 216,000 inhabitants, it's monocentric, so we thought that one is easy. And okay, it also has the big advantage that I know the town, which, it's easier to understand the results. We ran the simulation and predicted here the customers per store. Yeah, the data, the input data is shown here. So, okay, this is just the area that we know where we are. That's the complete town area. We just picked here the center. We have the population in this 100-meter grid, which is 23,000 cells, I think, for this town. So it's quite a lot. Those are the locations of the 103 supermarkets we see here. And we have the road network. The simulation results. So this is we zoomed into one supermarket because otherwise we don't see anything on the map if we have it for all 103 supermarkets. So here we have the road distance with the routing. So we did a routing from every cell to every supermarket. We have the population. This one here is the supermarket we look at. It's a Rewe store. It's actually here around the corner. And this is the distribution here for the gravitation model with lambda equal to 2. And here we have logit with beta to equal to 0.5. Those are the parameters of both of the models. What we see on the picture, the darker such a grid cell is, the more customers are coming from that grid cell to go to this particular store. And we can see it is very similar. So we don't see much difference. Even if we see the total number, which we cannot show in a map, it's nearly the same. Of course, we also calculated that for all the supermarkets, the difference is lower than 10% on average. So both models work quite well here. Yeah, the main results. It is possible to produce the same output. So yeah, difference on average smaller than 10%. There is a bigger difference for supermarkets located in area with a high density because of the fat tails of the distribution. So those customers would always go there according to the gravitation model, but not according to the Logit model. This is a difference. One very important thing is, at least for my taste, the Logit model is compatible with utility maximization. So there is some logic behind it and not this slightly esoteric physical thing. Provided enough data, which is difficult to get, but the parameters of the Logit model, they can be estimated, which is important. For the gravitation model, it's not possible, unfortunately. Even Hof himself said this in a recent article. Yeah, what's the next step? Of course, we need real revenue data, but difficult. We wanted to include agglomeration effects. It's partly already done. I wrote something last year about it, but it still needs some progress of agglomeration effects. And yeah, most papers are focused on grocery stores, so not very much else. Yeah, so thank you for your attention. This is the slide we have to include for the sponsoring. Yeah, any questions?
So thanks a lot, Sascha. So this was 18 minutes, more than perfectly in time, right? So there's room for more discussion. And so this is kind of big data analysis, right? Or at least a step towards that, if you get even more data. And using quite well-known models, especially the Logit one. So the floor is open for discussion. Who would like to start? Luca, please.
Hello, Sascha. You say that you can include utility maximization. I didn't see a utility function in your model. Is there a possibility to include, for example, personal income, something like that?
Yeah, well, this V actually here is this V is usually, or yeah, okay, let's say the Logit model itself is used in quite different contexts. So in the spatial context, we usually did not include income here, although it would be possible. I mean, the V is often it's considered as an indirect utility function. So it is possible to include other parameters here. What we did, I mean, this is a good, maybe that's a good idea. So what we did so far, if we wanted something else included in this model, for example, the agglomeration effect, then we usually include it into the attractiveness here, this A. So, but this is data not specific to the consumer, like the income, but specific to the shop. So we say, okay, a shop is more attractive if there are other shops in the area around. This is actually what I do in this other paper. For the consumers, in the moment we assume that they are homogeneous, and it's actually implied by the basic model here, this one here, because we just add up, and we do not, this probability here, this one is equal for all the cells.
Okay.
And of course, then we cannot include anything like you said, the difference in income, but it would definitely be very interesting. Yeah.
Thanks.
Did you check the Profit model too?
No, I did not, although it would be very, very easy. I mean, Python has all these libraries. This is more a one click and wait for half an hour. I definitely do that. Yeah. Would be interesting is, I mean, a Probit does not have fat tails, so it might
that's what
fit.
I thought. Yeah. Maybe a reason against, right?
Yeah, okay, yeah, but it would be interesting to compare, try.
Yeah. So then you would have 3 models: Probit, Logit, and Gravitation.
Yeah,
maybe also interesting. Good. Okay, so we already are out of time. I just realized it's 9:40, the official slot. Thanks a lot, Sascha, for your talk. And the next one would be by Andreas about low carbon economy in Wuxi city. Hope I pronounced that correctly. Andreas, it's your turn.
Yeah, thank you, Alexander, and thank you, Klaus, for your invitation. And yes, it was good. Wuxi is Wuxi. Well, it's one of those Chinese towns with 5 or 6 million inhabitants, and nobody knows it. But it's really a nice town. Okay, I will share my screen. Now, okay. Can you see it?
Yes.
Okay, good. Well, then, so I will first talk a little bit about the background, and then China's NDC committed under the Paris Agreement, Wuxi city a little bit, and its low carbon city plan, then the research questions and methodologies, and then the results of the business as usual and the low carbon city scenario, which I'm comparing. And hopefully I have time for the summary. Maybe I have to skip for time reasons. So as you can see here, China's CO2 emissions, they increased considerably during the past 20-30 years. Now it's already about 30% of the world's CO2 emissions, and it's still increasing slightly. The structure of the primary energy supply in China, though, gives us a little bit of hope. As you can see here, the share of non-fossil fuels is increasing about 10 to 15 years as China is massively investing in renewable energy sources, and subsequently the share of fossil fuels is decreasing. So there is a kind of hope for the future. Well, urbanization is a real challenge in China. Currently, or last year, the urbanization rate in China was already 64%, and there was a study from Morgan Stanley, and they predicted an urbanization rate of 75% already in 2030, with more than 1 billion citizens in urban areas. As you know, cities are not only the source of greenhouse gases, but they are also highly vulnerable to the negative impacts on climate change, especially sea level rise, droughts, etc. In coastal regions. I have two examples here. There was a survey done by, or an analysis done by Climate Central, and they predicted how climate change would impact Shanghai and Hong Kong. And they had a 2% warming scenario and a 4% warming scenario. And what you can see, especially in Shanghai, in the 4% 4-degree scenario, there will be huge parts of the cities underwater. So it could be a real threat for coastal cities in China. In China, cities, they only cover 1% of the country's surface, but 85% of the Chinese GDP is generated in cities, 90% of the industry is located in cities, and cities are responsible for 75% of energy use. So China has its nationally determined contribution commitment under the Paris Agreement. They want to peak CO2 emissions by 2030, increase the share of non-fossil fuels, increase the share of natural gas, and lower the carbon intensity by 60 to 65% in 2030, below the 2005 levels, and two others I won't mention. Last year, they came up with an announcement to have a carbon neutrality by 2060. So this is also providing a huge challenge for urban areas. So Wuxi city is a city in the Yangtze, at the Yangtze River, located in Jiangsu province between Shanghai and Nanjing. It's highly densely populated with a considerable per capita income. And the city had a pledge to reduce CO2 intensity of gross value added by 50% in 2020 compared to 2005, which is going beyond what was pledged on the national level. Well, the low carbon city plan was the key document in Wuxi for its low carbon development, with the specific goals for agriculture, industry, transport, buildings, and residential sector. And as I said, the pledge was to reduce CO2 emissions per gross value added by 50% in 2020. And this is going beyond the goal on the national level. So my research questions, I did that research together with the Wuppertal Institute a few years ago for the Mercator Foundation. And my research questions there were, how can the 2020 goal be reached compared to a business as usual path without this pledge? And can the goals be reached only following the national trend? And what I did was to model the Wuxi energy balance with an economic demand model and compare the business as usual scenario to a low carbon city scenario. The business as usual scenario was predicted for China by Zhang Kejun, this a well-known researcher at the Energy Research Institute of NRC. And I compared that to a low carbon scenario with specific targets for each sector to reach these carbon intensity targets for 2020, 2030, 40, and 50. I used or I modeled the energy balance of Wuxi cities, disaggregated by 17 economic 70 energy sources and 46 sectors. with final energy demand, primary, secondary, and tertiary and residential sectors. I did an OLS regression with an augmented Dickey-Fuller test on stationarity, and data came from the Wuxi City Statistical Yearbook. So the model logic is that these exogenous data, these technical and meteorological data, are determining the final energy demand, disaggregated by different sectors, and technical assumptions. They determine the production of oil, heat, oil products, heat and electricity, as well as the demand and supply for energy, primary energy, as well as intra-provincial imports and exports. The CO2 factors from IPCC, they are determining the amount of CO2 emissions then. Here is an example for the final energy demand in the different sectors. Important here is the CO2 intensity of gross value added for this sector, and there are different other variables: gross value added, population, technology, a dummy variable, and selected physical outputs of the products. The transport sector we could not model explicitly because there was no specific data available. Here you can see the business as usual scenario. What you can see, what I did was to keep this variable CO2 intensity constant for the single sectors in the business as usual scenarios. And you see that the primary energy in Wuxi will increase for the next years, of course. There were already considerable changes in the fuel mix in the business as usual scenarios, an increase of coal consumption, but decrease of coal share to final energy consumption, increase of cogeneration, the use of natural gas for cogeneration, increase of electricity consumption, and also electricity imports. At that time, renewable energies, they did not play a role in the low carbon city plan in Wuxi, and in the low carbon city scenario, according to that low carbon city plan, it was only introduced in a very marginal sense. I don't want to go into all those measures applied, but there were specific measures for power generation, agriculture, construction, services, and the residential sector. If you look at the low carbon city scenario, there was a variation of the CO2 intensity, a reduction according to the low carbon city plan. And what you can see, there is still a moderate increase of coal consumption, but a further decrease in coal share to total final consumption, significant reduction of coke consumption. This is due to the switch, the technological switch in the iron and steel sector to electric furnaces steel. This is also one reason for the increase of electricity. Further increase of natural gas, electricity, as I said, but renewable energy sources are still not relevant. Total emissions in Wuxi, they are reduced in the low carbon scenario by 11% against the business as usual scenario in 2020 and 8.5 in 2050. So main drivers are sectoral changes, intersectoral changes, shift from industry to other sectors such as services, for services, and also to energy consumption in the residential sector. Intrasectoral changes away from energy-intensive sectors to less energy-intensive sectors, such as solar industry. In Wuxi, there is a big solar industry, so this will increase. Technological changes, I said, in the iron and steel industry. So overall, the 2020 low carbon city pledge was fulfilled. There was a reduction of CO2 intensity of gross value added of about 55%, so more than 50%, and 80% in 2050. But if you see the business as usual scenario, they already were close to the pledge. So the difference is very small. Okay, I think I will skip the summary, and I thought thank you very much for your attention, and I'm open for questions.
Yeah, so thanks a lot, Andreas, for your interesting talk, and I also welcome more participants to the session. Welcome. So we have about 4 till 5 minutes for more questions. So I would like to start. So is this good news for the future? Do you think that China will reach the target according to the investments you observe?
Yes. Because without China, we won't reach the 1.5 degree target of the Paris Agreement. And China is investing much, but still, because China is such a huge country, they invest much, but compared to the total energy supply, renewable energy is still too low. As you might know, this year China introduced emissions trading for the energy intensive sectors, mostly power generation, and they used many years, more than 10 years, to really fulfill this. And I'm curious how this will work out in the future.
So if they don't get free vouchers, then maybe it works, right? So another question from the auditorium here, on the floor, on the virtual floor.
Yeah, maybe one.
Sascha?
In the press, I read more and more that China is switching to renewable energy and so on. I mean, in general, there seems to be a bit of a trend to, or let's say they seem to have realized the environment problem.
Yes.
Which was not the case before. Which impact does that have on this whole discussion? What do you expect it to change a lot in the future, or what do you think?
I really hope so. Well, you might have to differentiate between academia, the government, and the normal people. The normal people on the street, they still don't care too much about the environment, especially in rural areas. In the city areas, it's quite different, because there they really feel the impact of climate change and also local pollution. So in the cities, the people are quite informed of changes in the environment sector. On the countryside, it's quite different. The people are not so well educated, and they care more about their personal wealth and well-being. So it's quite differentiated picture there. The government, they know exactly there has to be done much, and So they are doing, but they could do even more, I would say.
Okay, so thanks a lot, Andreas. Next session will be on private and public financing of sports stadia. So that's a completely different topic, but it's also an empirical analysis and joint paper by Michael and Luca. And Luca is the presenter. It's your turn, Luca.
Yeah. Good morning, everybody. Thanks a lot for the invitation. Can you see my presentation?
Yes.
No? Okay. Okay. Yeah. We will switch now to a completely different topic. This is now about sports economics, but I would say this is a very important topic, especially from an economic point of view, because we are carrying out this research since many years, trying to analyze stadium financing projects, which are very large infrastructure projects, and they are financed until now very heavily by public coffers. So the question, which is the best financing model, is very important, even from an economic point of view, from a point of view of economic policy. And we will see that there are many different stakeholder interests, and we will try to assess which models are used at present, especially in Germany, which models are the best. And at the end, I will present a sort of simulation where we try to assess which dangers are rising now, which models could be suitable even in the future and which not. The paper is very long. It contains many case studies. I will put it very short, and I try to highlight a few focal points, especially because I know that I'm not talking to sports economists. So I will not talk a lot about details and very special financing models, but I will try to answer two questions. The first would be which financing models perform a better, private one or public one? And doing a simulation, which starting point do we need in order to have a suitable stadium financing? Remember that Germany will host the European Championship in football in 2 years or 3 years. So we will have now a wave of stadium financing. So this topic should be very important even for a public policy. I will start very briefly to give an overview of stadium financing through the ages, I called it. In the past, in very traditional times, stadiums were normally built by the cities. So they were as a municipally financed, and they were normally for many sports. And this changes only in the 90s, where a boom started. This was induced mainly by the British Premier League, where they started to build stadiums only for football, and with the participation of private investors. And we started then by with this models with mixed financing. And almost all new stadiums built since the 90s are mixed financed. We have now many challenges, and I'm talking on the situation before COVID-19, that especially in Germany, we have many stadiums which are really full, were really full. They have capacity problems, and we have rising requirements, environmental regulation, technical requirements. And we have one major problem in Germany. We have a resistance of the population to large-scale projects. We observe that even if sport remains popular, people do not want to have large-scale projects. And the question is what to do now, how to renew the stadiums facing this resistance and facing this financial problems. We have many stakeholders involved, which might have different aims. And what we observe now is that normally to have stadiums financed not only by one stakeholder, but you have mixed models. And mixed models almost always with a public financing part, because purely privately stadiums are still difficult. And I will show you why. One main problem is that stadiums are a large-scale project with huge costs, and you have to finance them, refinance them by current revenues. And in sports, especially football, current revenues do highly depend on your sporting success. And if you observe this official table here from the Bundesliga, the sporting success has a very strong influence on your revenues, so that the higher places get a much higher share of the revenues. So when you try to plan an investment like that, you face this very high uncertainty, and this makes this results in an importance of the public offer, which is a call to co-finance the stadiums. We observe a growing importance of hospitality revenues, and we observe a search of integrate more everyday uses like canteens, fitness studios in the stadiums, in order to diversify revenues. I will skip this. When we look at the Bundesliga, we see that we have many stadiums which are mixed financed. In the first Bundesliga, we have 7 owners of football stadiums and 11 tenants. This means that the stadiums are owned by a company which is mostly owned by the municipality. And we made a lot of case studies. We analyzed a lot of financing models. I want to show you one particular example. Schalke versus Cologne. We have 2 very similar stadiums with very similar costs. And the one, the Rhine Energy Stadium in Cologne, was purely publicly financed and operated up to now. And the Veltins Arena in Schalke is mostly privately financed. And if you do an in-depth analysis of their operating costs and the operating revenues, you can observe that the stadium in Cologne was never profitable in not one of the years we analyzed. So the municipality of Cologne had every year to cover a part of the cost. While the stadium in Schalke, which is private, had positive revenues, a positive net profit in each year we analyzed. And this profitability was even higher than the average of the construction sector. So we cannot fully prove that this is due to the private ownership, but we observe that you have a higher commitment to be profitable if you are privately owned and operated compared to a publicly operated stadium. When we look at and what does it mean to finance a stadium in present-day Germany? And this analysis was carried out slightly before COVID-19, and we are still looking now if things will turn out to be more normal in the future. But in normal times, we try to study which are the prerequisites in order to finance a stadium. And as we set up an example of a stadium with 60,000 seats, which is half financed by club and half by an investor. And the public sector finances the surrounding infrastructure. And this stadium is medium to large. This means that it has an investment volume of 250 million euros. And the financing is mixed. And we studied different cases because we know that the revenues are highly dependent on the sporting success and also of different types of use. For example, if you have some concerts or not. We try to focus on the average of German stadiums for what concerns ticket prices, for what concerns occupancy rates. And we studied what happens for these three scenarios. And what we saw is that if you look at the worst case scenarios, this would be here the gray line, in this very common and very standard case of medium to large stadium, you would never be profitable when the worst case scenario is given. And even in the base case scenarios, which is more or less medium, so you would have medium occupancy, you would have two National Cup matches and as the 6 other events, then you would have achieved profitability after 25 years only. And this means that it's really not easy to have a profitable finance stadium in normal times. And the same is a result is given by a free cash flow analysis, where we see that in the worst case scenario, you would never have a profitable financing of the stadium. And the worst case scenario, these are things which might happen. For example, if you look at the Corona crisis, where you had a worst case. This is why we conclude that the fact that we observe now that this mixed financing models with a public participation are now the very common ones. This is this makes sense, because to have purely privately financed stadiums is different in even in a normal setting. And we also observe that a privately financed stadium is normally more profitable. And the thing is, one has to search for a compromise in order to to have a compromise between this higher profitability and the need of support by the public hand. One remaining question is the political feasibility, because we observed this resistance and we studied it in many case studies, for example, Frohwerk, where you had many fights in the public in order to convince people to buy this, to build this new stadium. So we conclude that Bundesliga is on the right way to set the standard of mixed financing. We have to see and to look what will happen with the COVID-19 crisis. If we will return to a normal situation with normal match the income, because if this would not be the case, then we would have a worst case scenario where not one of one of profitable stadium financing would be possible. Thanks for your attention.
Yeah,
and
thanks a lot. Mille grazie, Luca, and 15 minutes and interesting topic. So I remember quite well an event at Veltins Arena, and what I learned there, it's not a stadium, but it's a multi-purpose arena. So they can use the stadium without the lawn, and the lawn disappears from the stadium, and then they can do other events. So multi-purpose arena. So that's what comes in when you come up with private investors who want to make money, want to make profits. So what about comparability? So are these in fact two different investments?
Yeah, this is not true, but even in Cologne, you can have concerts and you can have different sports. So the usability would be comparable. What we see is that as the municipality of Cologne wants to have a broad approach to include more sports, but we see that the stadium is not profitable. So the taxpayers are called to repay a part of the losses each year. And this is a question who should be answered. If the taxpayer wants to do it.
All right. So any more questions from the floor, please? Hands up. Or just unmute.
Yeah, I have one question.
Yeah.
What do you expect for the future, Luca, for the financing of the stadiums? We right now had COVID-19, and I think now private investors are probably a little bit scared, but we have the European Championship ahead. So what is the future of the financing? Will the private investors come back? Because it would be a good thing, according to your analysis. What is your view on that?
Well, at present day, the branch is as more optimistic. It seems that we are returning now to a more normal life. So for what concerns football, I expect that a private investor will come back. I'm more skeptical regarding other sports. I do not see that we will host Olympic Games in Germany in near future, because there the resistance of the public is even higher, and to include private investors is even more difficult. So for other sports, it might be difficult. For football, I think that we will have now a more normal situation in the next years. Andreas.
Yeah, I have one question for Cologne. To what extent does the city of Cologne participates in the revenues, for instance, for advertising and all these kind of things? I guess the clubs who are running the stadiums privately, they can use that money for counter or co-financing the investment, but maybe the municipality cannot. How is the situation there?
No, they get 100% of the advertising money of the naming rights. They get 100% of that, but this is not enough to cover the costs. And so at the end, they make a negative net profit. And this is the problem. And so they get money, but they lose more than they get.
All right. So thanks a lot, Luca, for that interesting stuff. So with respect to public investment, and people should get more aware of what taxpayers' money is spent for, and that's a nice example. The next speaker, I guess, will be once again Sascha. I'm not sure. I also saw Holger Wassermann in our session, but Sascha and two co-authors beyond Holger, third co-author is Carsten. It's an evolution or revolution, the entry of new company successors in Germany. Sascha, will you once again?
No, we do it together. So Carsten is starting, then I take the middle part, and then he continues. So I would just say next when I need the next slide, then when it's my turn.
Okay, so please feel free.
Okay, and
hello, Carsten.
Good morning
your turn.
to all. Can you see my slides?
No, okay, we see the presenter mode.
Okay.
Better, but not perfect.
Okay.
So it would work like that.
Bildschirm duplizieren.
So it's fine like that.
Okay.
Read it. No.
Okay.
No. Yeah. No,
yeah.
No.
Gone.
Yes.
Okay.
Yes. Please.
Get digitalizing us. Okay. So. Good morning to all. Again, we look at our study at the entry of new company successors in Germany, and we titled our small analysis "Evolution or Revolution," because we look in depth how different are the successor and the predecessor. So what we think is that if the difference between they is very large, it feels like a revolution if the new comes to a company. There is much younger than the old one. So it might be an advantage for the company or a disadvantage, we don't know. So therefore we look what is different between both successor and predecessor in a company succession. The idea behind is that we have a succession monitor which is a very huge source of data. So data concerning a successor and predecessor, the company itself, and the transaction in the company succession. So on the other hand, we have a huge proportion of small and medium-sized entities in Germany, which are numbered at 99% of all companies, and a lot of them are facing with the challenge to transfer a company from an old entrepreneur to a new one, a younger one. So, and we don't know a lot of this succession. Our roots coming from the from sustainability thoughts. So if you look at the white box on the left-hand side, the Brundtland report defines a development is sustainable if it ensures that it meets the needs of the present without compromising the ability of future generations. So if we look at economical issues concerning that, we're talking about the economic sustainability. The triple bottom line on the right-hand side comes from Elkington, but as far as I know, this is meanwhile common knowledge. So the three pillars, and the economic pillars is what is related to our analysis. So if you look at the company succession, the middle here, so we look at where a company is transferred from a old generation to new generation and younger generation. This is a generation of a successor. The old generation comes from the predecessor. They have different, or that is what we can observe in reality. They have different source, different aspects, and different ever. They are just older ones, so than the younger. So, and therefore we look at this company succession as a moment where a cross-generational company transfer enables us to look in deeper insight to this transfer of knowledge, of just economic power. Okay. Sascha.
Yeah.
Do you want to go on with that?
Oh yeah, I will introduce the data and a couple of analyses we did here. So the database we are using is a database from the Guarantee Banks Association of Germany, so Verband Deutscher Bürgschaftsbanken. We have nearly the complete database. The only thing is, of course, they deleted names or precise locations so that we do not know which company or which person this is. It's the data for 8 years. So from 2013 to 2020 is the current one. There's also a little bit of data from Kreditreform rating, especially on the old owners, because the guarantee bank usually only has the information of the new owners, since these are their customers. So just to have an idea, we have around 8,000 companies which got a new owner in this period of 8 years. We have 9,600 successors, a little bit less predecessors, just due to the data. It's not that those companies don't have some, but we don't know who that is. We have the annual reports. We have data on the transaction, and of course, we also added some data from the official statistics to analyze the data. Yeah, next, please. Yep. Yeah, we looked at the age difference because we think age difference is the most important thing. So if someone, if a company has a new owner and this one is just 10 years younger, there might be less change, less revolution, as if there are 30 years in between, for example. And it was quite interesting to see how different that is for different industries. So I excluded here everything with too little data, so to just get valid results. But we can see in the top, for example, here, arts, entertainments, recreation, and also hospitality. We have young, yeah. So the company goes from a young old owner to a young new owner. Complete opposite for real estate, for example. So on average, the old owner then sells at an age of 63, while we have 52, for example, with arts, entertainment, recreation. That's quite interesting. The biggest difference we have in construction. So don't know why construction and other services, but other services, of course, is difficult to explain, right? The average age difference is 90.4 years, so roughly 20 years difference between the old owner. Those are the blue dots here, and the new owners, which are the red dots on this slide. Yeah, the standard deviation is 30.2, which is quite a bit. So when we see the detailed data, we really have companies where the old owner is 85. Some people really work until this age, selling at 85. I think the oldest one in our database is 93 years old. And if that then goes to someone of the age of 20, you can imagine there's quite a change. Yeah. Next, please. Yeah, we also looked at age, sex, and family background. Especially family background is interesting. Why? Well, in the literature to entrepreneurship, you often find a statement that the family background is important for the performance of an entrepreneur. So the idea is someone with a solid social background performs better because he's more resilient to crisis. That's what you always read. So we looked into it. First, we found out that the new owner usually, or the majority is male, coupled males. This is the big group we have here. Interesting, and yeah, also not that nice, I think, is the share of women is quite low. So we have 23% women buying a company, while even when you look at women in leading positions in companies, there's usually something around 30%, 35%. So this is really, really low. Those who buy, they do it earlier. So you have a lot of women doing that at the age of 25, for example. We have the first peak. That's a difference here. The one thing I need to say is we do not have this precise information on the old owners. So here we can only make assumptions and compare to the average of the population. Unfortunately, we don't have that. Yeah, next, please. Yeah. So this is what we did here, and I think that was quite interesting. We compared the family background for men and women of the new owners with the population average, and that was surprising when you see the young men. Or okay, I don't know if I would call all of them young, but between 20 and 90 and 39, sorry, there are significantly more married men than single men buying companies. This is something I think this is quite significant. At the age of 40 to 49, this is not the case anymore. Then it's like the average is. Interesting also when you compare exactly that to the women, because there it is, at least for the age groups between 30 and 49, it's the exact opposite. So the darker bar here is successes, the lighter bar is a population, and here we see that women at this age buying a company are more likely to be single than being married, which is quite an interesting result because it's so opposite to the men. Yeah, next, please. Yeah, of course, I mean, I'm in spatial data, so I did need to do a spatial analysis here, also with the idea that someone who comes from abroad might have a different view and a different style. I mean, you can imagine someone from Kiel buying a company in Munich. I think that will be a cultural shock for the company. So we wanted to know how it is, where do they come from? And this information we have. We do not have the precise location, but we have the district, so Landkreis. So they are small enough to for such an analysis. I think this is okay. And also this first slide was interesting. So we see that 68% are coming from the same district. We don't know if it's the same community, but it's definitely the same district. Most likely, of course, this is people who were employed in the company, for example, or family. What we then did is a spatial analysis. So we looked of neighboring districts. This is possible in PostGIS, so you can see which one has a common border with the other one. So 22% are coming from neighboring districts, and only 9% are coming from districts which are more far away. So how far? That was the next question. How far are they? What we did is we calculated the geographical center of the districts, and then we calculated the air difference, the air difference between those centers. So that's what we do on the next slide. Yeah, so here we looked at those districts which are not the same, so which are somewhere else. On the left side, we see the distance, and that's quite interesting because we see even if this the new owner comes from a from a district which is not the same, it's not far away usually. So we see most of the data is below 200 kilometers. Even a lot of is below 100 kilometers. So they are quite close. Of course, we have cases of 800 there. So this is really something like Hamburg, Berlin, Hamburg, Munich or something, but it's rare. It's really rare. What we also looked at, there is a classification for all districts in rural and urban districts. So we wanted to know how it is coming, are constantly, okay, what could be is that people from rural areas go to urban areas to buy a company. Actually, we did not really see that. So of course, a little bit, the number of urban areas here is a little bit higher for the company than for the successor, but not much. There is a, it's, yeah, you see that, okay, I can't point here now, but you see the bands in the bottom of the picture here.
One more minute, please.
Oh yeah, Sascha? Yeah, I'm done. That's my last slide.
Okay, there's just one open question so far. So we looked at the final development to get an idea of are they successful by their company succession. So first of all, we looked at a revenue factor where we compare the revenue situation 2 years before the succession to 2 years after the succession. So what we found is that 70% of all acquired companies were able to increase their revenues compared to the situation before. But half of them, or nearly half of them, sticks very close to the old level, which is in a range between 25% less or more than the old level was. Revenue is one thing, and the profitability is the other. So profitability situation we measured here by using the EBIT, the earnings before interest and taxes, because the EBIT is independent from a special tax or interest situation. What we find here is that more than 60% stick close to the former EBIT level. More than 60%, and after succession, 45% of the companies showed smaller profits than before. So it was a slight decrease in the EBIT level, but it's not very serious for the companies. So finding new owners often achieve their former revenue and profitability levels. We interpret that as they were able to stabilize their customer relationships.
Okay.
Okay.
So, thanks a lot, Carsten. Thanks a lot, Sascha.
Last slide, summarize it all. So to ask if you have an evolution or revolution, we can answer this question. It depends. Okay, so
okay. So
if you have any question,
be free running out of time. So thanks a lot, both of you. And,
thank you very much.
So we have 1 minute plus left for the discussion. So in Germany, we live in a land of scarcity of successors, right? So it's not a dreamland, but we have a real successor problem. What is interesting is to see that our companies are at least partly bought by companies from abroad, from China, for example, or also from the US. Do you have also data on that?
No, we only have data from Germany. That's all.
Yeah, but you mean a German company bought from abroad, right?
Right.
No, I think two things. One thing is the companies we are looking at are usually too small for that. So the data is from the guarantee banks, and there is a selection bias towards small companies and also towards difficult financial situations. So if a Chinese company would buy a company, okay, I mean, we are looking at companies until up to 250 employees, but most of them are smaller. Most of them are much smaller. So I think we just don't have the data on that.
And we have a guarantee bank who supported the deal. So they wouldn't support a Chinese deal, I think.
Yeah, right.
Okay. And Kreditanstalt für Wiederaufbau, they also have monitoring data. Did you use that?
No, not yet. They're a little bit different to the data we have. We have real transaction, and as far as I know, they use some interview technique. Or Sascha?
Yeah, although we are in contact with them, so we had a joint event. Yeah, the last real event before COVID, where we met them and also the chief economist from them. So we are in contact, but we are not using the same database.
Okay, so still room for an urgent one from the auditorium. Any?
We have one in the chat, right?
I haven't checked the chat.
Oh, yeah, just popped up here.
Yeah. Okay.
But that was regarding the size of companies, I think.
So maybe you answer that. Yeah.
Now we only have data for small companies just because those are the ones supported by the guarantee banks. So something like here, AXA, for example, we don't have anything. But I think the mechanisms are very, very different. I wouldn't even want to analyze that together. It would be a different story.
Okay. All right. So thanks a lot, Sascha and Carsten. And now we come to the last presentation. So this is a joint paper with Kai, and Kai will be the youngest participant here and present for the first time at an international conference a paper. So Kai, it's your turn. Good luck.
Yeah, thank you. I'm going to present my. So everyone can see my slides, right?
Not yet.
No?
Soon? Now, yes, it works.
Okay. Yeah, thank you. My name is Kai Klotz, and together with Alexander Sperman, I'm going to present our topic, Does Immigration Cause the Rise of Right-Wing Parties? Empirical Evidence from East Germany. As introduction, on the left-hand side, we do see a colored map according to the latest parliament election in Germany. We do see a lot of red areas, that meaning one areas by the social democratic parties and a lot of black areas won by the Christian Democratic Union. Most interesting are the blue areas, meaning those areas are won by the AfD, Alternative for Germany, in German Alternative für Deutschland. In this year's parliament election, they won 10.3% of the vote shares, meaning they have a loss of minus 2.3 percentage points. However, if we look only into Thuringia, they received 24% of the vote shares, meaning a plus of 1.3 percentage points. And today we're looking only into Thuringia, that is the circled area in the map, but also noticeable that in Saxony, the AfD is also pretty strong. In speaking terms of magnitude, we do see here the total numbers of foreign citizens in Germany in the orange line from the year 2000 to 2019, from 9 million to 10 million during the time of observation. And for Thuringia, the blue line, after the refugee crisis peaked in 2015, it's doubled to 100,000 from 50,000 approximately. Here on the left-hand side of the graph, we do see the 5 layers in Thuringia, and we see that the AfD party vote shares are significant increasing over time. On the right-hand side, we do see again the total numbers of foreign citizens in Thuringia. If we consider both graphs together, we see a strong correlation. However, we do ask ourselves, is there a causal effect? And that leads us to our research question. The increased immigration have an effect on vote shares for the AfD party in Thuringia? Before we start presentation our method and empirical strategy, it's important to talk about 2 papers. The first one is from Lonsky this year. He investigates the effect of immigration on voting for the far-right parties in Finland. And he suggests that a 1 percentage point increase in the share of foreign citizens in a municipality decreases the Finns party's vote share by 3.4 percentage points. The Finn party in Finland can be seen as a right-wing party. And his method is he uses a shift share instrument, and that is based on historical settlement pattern. Also, Steinmeier presents results of the effect of incoming refugees on voting for the FPÖ in Upper Austria. And also he suggests a negative causal effect if the share of foreigners increases, meaning the FPÖ, it can be seen as a conservative right-wing party, decreases its vote share by 2 percentage points. Those papers are highly to mention because they claim to be the first ones that find a negative relationship. When we tried to estimate the causal effect, we went through different approaches, namely the randomized controlled trials, regression discontinuity design, and the different-diff. However, for our method, the instrumental variable approach seems to be the most suited one. Our data, we created a novel panel data set with 4 elections and 635 municipalities in each year. We investigate a time period of from 2012 to 2019, and within that we had 2 federal state elections and 2 state elections. We conducted our data set from the Federal Office of Statistics and from the Central Register of Foreigners, Ausländerzentralregister. Our empirical strategy is straightforward. We set up a baseline fixed effect specification where we have on the left-hand side the dependent variable AfD vote share in year T in municipality I equals the constant of the model plus our endogenous variable, which is the variable of interest. It is defined of the share of foreigner in election year T in state I, and it's the fraction of foreign citizens in state I in year T divided by the population in state I in our base year 2012. We also included some municipality specific time varying controls such as unemployment rate and the population size, and we controlled for exogenous shocks such as the refugee crisis. Also, we did include some specific time invariant determinants such as the size of the area of the municipality, for example. And also, of course, the error term is given. However, if we consider the baseline specific model, we counter the endogeneity bias, meaning that the covariance between our variable of interest is not 0, meaning we may have an omitted variable bias that has explanatory power for the model. And to counter that endogeneity bias, we figured out some possible bias first. First of all, the distribution of foreigners is not randomized. We're not only talking about refugees, but also, for example, in Thuringia, there are living a lot of people from Russia, and they are freely choose to live where they want. And the literature suggests that people try to avoid anti-immigrant areas and are more likely to live in areas where already their share of foreigners for their own citizenship is really high, meaning we have an upward bias. Also important is that candidates for the parliament, they may talk about immigrants in total, even though in their area, there are not even a lot of refugees or immigrants. So we also have there an upward bias. Also, if we do not consider economic opportunities such as better school education, higher wages, then we also have a possible bias. And from the literature also, we can tell that economic downturn also increases the immigration, for example, if the rents are lower. To counter the endogeneity bias, we run an instrumental variable approach where we see first the baseline specification again, and our variable of interest, the share of foreigner, is now instrumented by foreigners in the AT in state I. And it's defined as we see here, the numerator is the sum of foreigners from country J in time T multiplied by the share of foreigners from country J in state I in the base year 2012. And the sum runs to 10. That means we're looking into the 10 most frequent citizenships in Thuringia. And the denominator is the population state I in the base year 2000. The valid instrumental variable approach, two certain conditions need to be satisfied. First, the relevance condition, meaning the covariance of the instrument set and the variable of interest must not be zero. Otherwise, we would not have an effect. We run a first stage estimates and we get a meaningful first stage regression because we see that on the 1% level, we have significance effect. So the first condition is satisfied. The second condition, the exclusion restrictions, simply speaking, the instrument Z affects the outcome variable Y only through X, and that cannot be measured, but must be plausible explained. And our argumentation is as follows. We chose the base year 2012 because it's the year just before the AfD was founded in 2013. Meaning if our predicted share of foreigner is also based on 2012, there cannot be a direct effect from the instrument on our dependent variable since the AfD year. So now that we have a valid instrument with those two conditions that we explained, we're looking into our descriptive statistics, where we have here the dependent variable AfD party's vote share and the variable of interest share of foreigners, and we show you some more control variables such as the density, the area per square kilometers, and share of females, for example. Our main results from table 3 show 6 columns where we have 3 columns where we run the OLS approach and 3 columns where we run the IV approach. As we can see, if we do not count for the endogeneity bias, we have a strong upward bias in the OLS approach, as we can see in the first 3 columns. However, if we run our full specification with the IV approach that counts for the endogeneity bias, we can say that 1 percentage point increase in the share of foreigner increases the AfD party's vote share by 20.51 percentage points. To recap our paper, as mentioned, and 1 percentage point increase in the share of foreign citizens in Thuringia increases the AfD vote share by 20.51 percentage points. And to explain our main findings, we run also a heterogeneity analysis where we looking into potential mechanism that drives our main findings, such as an unemployment rate, population density, and the share of immigration. That's pretty much it. If you do have any questions, please now. Thank you.
Yeah, thanks a lot, Kai. So this is the shortened version of a longer presentation. So there's a lot of in the backup. So the amazing result here is that, well, at first glance, you might think that a higher share of immigration leads to a higher share of AfD votes. That's what we know from first glance look at this issue. But in the literature, we find opposite results. So this is what attracted us to do more research here using an IB approach. So any questions from the floor?
Well, Alexander, the obvious question, of course, is why is this difference? Because what you get is what we all would expect at the first sight. Why has the literature found something else?
Yeah, sure. If we consider Lonsky's approach, he investigating the EU enlargement from 2004, meaning the natives, the local people have a different expectations of people that are coming in, meaning the EU enlargement were meant that people from abroad come to work. Also, he considers the welfare state channel with wages, and he finds that if there are more immigrants in a municipality, the tax revenue is getting higher, so everyone benefits, and the natives are not prone to vote for the right-wing parties.
Yeah, that's an interesting part. I think we've seen that, Klaus, also in Turkey, right, where Syrian refugees entered Turkey, and at the end of the day, they were absorbed by the labor market. But here, that's the welfare state channel, so that they obviously they work, right? It's not only about refugees; it's about immigrants overall. They work, and then they contribute to the tax revenue, and that seems obviously to undermine simple right-wing party thinking.
Yeah, so it's not comparable, actually, so to speak. The different type of, very different type of inflow. Okay.
Yeah.
Even also, of course, some of the refugees also work. We know that the employment rate after a few years is rising. It's not zero. Okay.
It's not zero. It's rising. It's 50%. But yeah, that's what we have to look into much more. Yeah, what are the driving mechanisms? What are the differences, institutional differences, the structure of the inflow? And here we cannot differentiate between refugees and immigrants according to these data, but these are not survey data, these are administrative data, and it took a while to get them. Yeah. Any more from the floor?
There are two more, yes, there are two more. Sascha and Andreas, I think.
Andreas, yeah.
Yeah, I just recently read something which was not according to the AfD, but to the Green Party, which is kind of the opposite in the eastern part. I think they say one reason why the vote share of the Green Party is quite low is that the age structure is different. So a lot of young and more innovative people moved, and the remaining ones, those are those who want stability. They don't want a change, they want stability. Is that age structure maybe also something that could explain that to some extent?
Yeah, we run a heterogeneity analysis. I have that in the backup, actually. So here, and we see that if we in this analysis, we separated few variables into above their own median value and below their median value as interaction with the share of foreigners. And if we consider the 1 and 2 column together, we see that if the population and population density is below its median value, meaning that the AfD vote share is higher as if it would be above their own median value. We conclude from that in rural areas where people are from the age structure older, more prone to vote for the AfD share. So the age structure is really important. We also have that as a control variable. We include people only also older than 65 plus, and that has a significant effect on the AfD vote share. So in favor for them.
Yeah. So thanks a lot. And Andreas, the last one, then we are done for today.
One question. The immigration, it makes a huge part of the campaign of the AfD. Although, according to your findings, the voters do not react much on this immigration issue. So could that be an argument that the AfD party is more a protest party against the established parties, the other parties?
Okay.
Can that be seen in a protest? But well, as we saw that in the beginning, the AfD is founded in 2013, so it's not a one-time phenomenon that people vote them to be have a protest party, but it can be seen now as a rather stable party with their own agenda, even though most of the time it's against immigrants or refugees.
All right, so thanks a lot to all of you, to all participants, to all speakers, and it was a pleasure to be the chair of this session. So thanks Klaus and also Tolga for organizing all that and inviting us. So it was the first FOM GLO session here at the conference, and we hope to see more in the future. Thanks a lot.
Thank you. Thank you.
Thank you.
Thank you.
Nice.
Thank you. Bye.
Thanks a lot.
Bye-bye.